Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital Group. Very excited for today's show. We've got, second-time guest Neil Wahlgren on with us today. He was previously on podcast episode number 111 from March of 2021. So it's been a hot minute, Neil. So how you doing today?
It's great. Yeah, I really appreciate having me back on the show after a couple of years.
Yeah, for the listeners, we were just kind of catching up a little bit. We've got a lot to talk about today. So let's launch right in. And Neil, do us a favor. Tell us about yourself up front.
Yeah, a little background on me. Neil Wahlgren. I'm a partner at MAG Capital Partners.
Mhm.
Been with the team at MAG, I think it's
Mhm.
coming up since about 2016 or so.
Yeah.
And ultimately, my background, live in San Francisco, California native, had a prior career as a C-130 Hercules Air Force pilot.
Yeah.
So got to live all over the world and fly
Mhm.
a lot of places, combat
Yeah.
deployments to a lot of the same spots you went. You,
Yeah.
you might have been in the back of a C-130 or two at some point.
I've been in the back of many C-130s. And, I could tell you one thing. You can definitely tell the difference between the back of an Air Force C-130 and a Marine Corps
Ah,
C-130. But
I can imagine.
yeah, the Air Force one's a little more comfortable. Let's just put it that way. But
Did they put you in
um,
first class?
every once in a while, there were a lot of pilots that I knew, and when I was deployed and I was flying a Marine Corps C-130, I'd always ask the crew chief, who's the pilot, and I was an officer. I, had big shiny, rank insignia on there, so people, you know, who's the pilot? Oh, hey, so if it was somebody I knew, I would just say, hey, tell them I said hi, and they're on the intercoms. I mean, you know that, but they're on the intercoms, and they'd be like, hey, Colonel Briscoe says hi or whatever, and next thing I know, I'm sitting up in the cockpit with them. So that was the best way for me to get the first class treatment, was just like, hey, who's flying today? But yeah, it could have very well been in the back of one of yours as well, because I flew Air Force C-130 all the time. But anyway, yeah.
For the listeners, first class means you actually get a cushion to sit on instead of cargo netting on the back. So just to set some expectations there.
Yeah, I mean, the way I look at first class is, I mean, there's only one first class seat, and it's that one extra spot up in the cockpit,
Yeah.
and then that's it, But
And you gotta fight whoever's up there for a little
yeah,
hip
yeah.
space up
So
there.
if you offer to bring them coffee, make sure that they have a coffee with them. That you'll get that seat every time. But
Yeah.
cool. Well, hey, thanks for your service. Very very much appreciate it. And so let's talk about, real estate. I mean, I know you've done multifamily, you're doing a whole lot of industrial right now. So let's talk about, we talk about multifamily all the time on this podcast. So why don't you tell us a little bit about, why you're doing industrial, and kind of compare and contrast the two? Because I know you still do both. What's the benefit of industrial over multifamily and vice versa?
Yeah, no, absolutely. And a little background just from a qualification side, my previous firm, we were more focused on the capital relationship side of things, and we would partner with different really real estate JV
Yeah.
professional experts. So I had experience, partnering and raising capital for a number of multifamily,
Mhm.
also industrial, some retail, a number of different asset types. And that was actually through that role was how I met my current partners at MAG. But
Nice.
with,
Nice.
with it, in full disclosure, I've got holdings in multifamily personally. I've got holdings in industrial,
Mhm.
and they really complement each other well. In general, especially for the listeners here, very familiar with the multifamily side of things, and how, it's really, not going to say it's easy, but
Mhm.
conceptually, the idea of adding value, of adding
Yes.
improvement, kind of the incremental increase on, your monthly monthly rent
Mhm.
multiplied by, a larger number of units can create a really sizable increase in NOI,
Mhm.
and really direct value. So
Yeah.
industrial is a little different, where we add value. However, rather than it be, bringing in crews and improvements and raising rents incrementally, more of the value on an industrial net leased investment structure is going to be more contractually through the lease that's set up. And so I'll talk a little bit
Yeah.
more about that. So you have to back up a bit and kind of picture the type of assets that we're buying.
Mhm.
And that's typically, you're going to have a Midwest based what we call light manufacturing warehouse. That's going to have some sort of combination of manufacturing, of warehousing, shipping and receiving, and perhaps some distribution. You're
Mhm.
going to typically have 40-foot ceilings, a couple of high bay truck doors for in and out, coming in and out of the building, sometimes a rail spur. And they're typically not going to be in your downtown metros.
Yeah.
Usually they're going to be what I call commutable primary or in secondary cities. That's intentional. You've got basically highway access. You've got access to low cost of labor. And that's
Mhm.
really the sweet spot for most of the manufacturing and industrial sector.
Got it. Got it.
So we come in and we are effectively an alternative financing partner
Mhm.
for owner operators. So
Mhm.
imagine you own a company, you make widgets, we'll call them car sprockets and
Yeah, I love widgets. I've been making those for a long time. So
exactly
yeah,
right. We're
yeah,
talking the best widgets, on this side of the
known to
country.
man. Yeah,
Um,
absolutely.
so if you want to say grow your business
Mhm.
or if you want to access capital, typically as a business owner, assuming you own the building you work out of,
Mhm.
you can either raise money for the business,
Yep.
dilutive equity. You can borrow either
Mhm.
lines of credit or bring on, a loan for the business, or you can use a group like ours and do
Mhm.
what's called a sale leaseback. So
Mhm.
effectively, we buy the real estate and simultaneously lease it back to that operator. So
Mhm.
that operator, nothing changes in the building.
Yeah.
Every day widgets continue to be made,
Mhm.
but just a paper transaction happens where that operator gets a injection of cash in return for a long-term, typically 20-year triple net lease obligation on the backside.
Nice. So the benefits to the operator is obviously they get the injection of cash. So when they sell the building, they're basically liquidating that asset. They get the injection in cash to grow their business however they want. And on the back end, now they're paying rent to you instead of paying, presumably a mortgage that they would have had on the land, the building, and everything else itself.
100% there. Yep. And then the structure of that lease is going to be a little different than multifamily.
Mhm.
So, as a multifamily operator, you typically will pay the property taxes on the
Mhm.
building yourself. You will pay likely some element of the utilities. The biggest thing you, as the owner operator for a multifamily asset, are going to have to keep reserves and invest in the ongoing maintenance and upkeep of that property.
Mhm. Yep.
Uh, Imagine a scenario where each
Mhm.
of the tenants actually paid all those items directly on your
Right.
behalf. So,
Yeah.
and
Yeah, that
that's
makes things a lot easier. Yep.
so we have one single manufacturing tenant.
Mhm.
They pay their own property taxes on the
Mhm.
building directly.
Yep.
They pay all their own utilities.
Mhm.
They pay their own insurance as well. Catastrophic fire, flood, whatever. And then the last piece, they pay for all building maintenance during the course of that lease. So
Right.
everything from small stuff like bathroom repairs, new sinks, bathroom remodels, flooring, even to things like roof replacements, repaving the parking lot. All those elements are going to be effectively paid directly by your tenant. So that's the main difference there on a net lease versus the more typical lease there.
Yeah. So one question about that. I mean, I get everything, all they're paying for everything. But the one thing that, would worry me about, coming into an agreement like this is the maintenance. How do you as the owner of the building make sure they're maintaining it properly?
Yeah. And so there's what the lease says, and then there's kind of reality, right?
Yep.
And, usually reality is somewhere in between there. But the way we enforce our tenants maintaining the property the way they're supposed to per that new lease, a lot of it is leverage. So we'll come in before we do this transaction, we'll send in a heavy building inspector, top to bottom, who will basically identify any sort of what we call deferred maintenance stuff that needs to be done. We'll call them roof leaks, pavement repairs, et cetera. And we'll identify all these and give it to the seller who's going to become the tenant. We say, listen, XYZ need to be fully accomplished before this sale takes place.
Yeah.
And that way, at least we know at the start of that lease, we have basically a building with no problems.
Mhm.
And if they don't do it, we say, oh, that's fine. We're going to escrow, maybe, withhold
Mhm.
about, say, $1 million from the sale proceeds, we're going to hold that until you do these
Mhm.
repairs. And if you don't, no worries, we'll do it for you out of this pile
And
of
yeah,
cash.
well, that's what the escrow comes in for. Okay, cool. So
Exactly. Yeah.
you are able to hold that over their head at least and make sure that things are going well.
Exactly. And you have a lot more leverage on the
Mhm.
front end than you do, a
Yeah.
little later down the road. So
I like that because you're holding it out up front, and a lot of lenders will do this when there's certain repairs that they want done. Is they'll escrow that repair money up front, and then you've got to ask them, pretty please, can I have this money back? But
yep, absolutely there.
cool, cool. Well, awesome. So something else we talked about earlier is actually before we hit something else. Anything else you want to talk about as far as the dynamics of the industrial properties before we move on?
So, we talked a little bit about adding that value. So it's interesting. A lot of the quote unquote value add on industrial is really kind of negotiating that new lease in conjunction with whatever sales price you have, setting up an institutional grade lease. Effectively, when you ink it, the vast majority of the quote unquote work has been accomplished, and at that point, you're more or less on the receiving end of the fruits of your labor that you planted on the front end, which could take sometimes between 6 and 9 months to fully execute a transaction like that.
Nice, nice, nice. All right, now moving on. We talked earlier. You said that you had previously started doing syndications, raising money for their operators, and then we talked before coming on that you've started a fund and you're now on, I think, your second fund. Is that correct?
Yeah, that is correct.
Right.
At Matt
So,
Capital.
let's talk about the fund model and why you guys decided to go presumably from a raise capital for each deal model to a fund model.
No, great questions there. So for many years, coming up on almost 10 years now, we were on a deal by deal basis, and each property we'd set up PBM, legal docs, and as we grew, really the frequency of these transactions correspondingly increased as well. So we started off maybe 3 or 4 deals a year, and then 6, and then 8.
Mhm.
And in 2021, I think we did 16 deals in the year, and it was a lot. Just you can imagine the transaction tempo, you can imagine the legal that goes into each property. And ultimately, specific with the industrial side, there's a bit of a binary risk factor where either your tenant's in business paying rent or they're not. And that 1 or 0 binary occupancy or vacancy, to look at it from the other side,
Mhm.
is a little disconcerting for some folks. So we ended up shifting really the same strategy, but ultimately, we started raising capital under an umbrella fund,
Mhm.
which correspondingly invests in roughly 12 to 15 different industrial
Yeah.
properties. Each
Mhm.
one's in a different geographic market. Each
Mhm.
one has a different credit tenant
Mhm.
who's signing on the lease, and those tenants are going to be in different industries. So
Mhm.
really, a huge amount of diversification, with the idea that each of those concentrations are 15% or less from an overall fund exposure.
All right. All right. So lumping everything together, which you mentioned brings diversification for the investor and makes it presumably a whole lot easier for you guys. Now, I guess some of the dynamics on the fund. I mean, do you typically have a lot of money sitting in the fund, or are you still kind of raising by each project? Does that make sense?
Yeah, and so really that a lot of that comes with the term used for that is cash drag. So
Hmm.
what you want to avoid as a fund manager is calling a bunch of capital, having that money
Hmm.
sit there and not be deployed
Hmm.
into effectively income generating assets.
Yeah.
So the more cash just sitting there, that creates what we call cash drag.
Hmm.
And so as a fund manager, you're always striving to be very efficient with your use of capital.
Hmm.
There's 1,000 ways to do it. What we
Hmm.
decided was, we're kind of in a high tempo area of real estate where, we will still buy 12 to 15 properties. There's a
Hmm.
lot. We
Yeah.
will get commitments from investors with a 90-day window to call. So we'll
Hmm.
say, hey, at the very, very longest case, you wait 90 days from signing documents to
Hmm.
when we ask for that money. Best case, we call it immediately. Effectively, that money starts generating a return right when we call it. And then
Hmm.
we're able to kind of call it, typically a week or two before each anticipated close for a very, kind of fluid, efficient use of capital there through the fund.
Right. So the fund is a little more efficient, and the investors, when they sign the documents, they just know that they have to keep that money somewhat liquid for up to 90 days.
Exactly. Yeah.
So
Yeah.
not, I mean, not terrible. I mean, most that they're probably going to have it, I mean, each individual investor is different, but I'm assuming they'd probably have it in some sort of ETF, some fund somewhere where they can just pull the money out and
I
throw it in.
absolutely there. Yeah. And what we try to do is I pre-identify, 4 or 5 properties
Mhm,
as we bring that fund to market. So
mhm,
typically we have a number of closes, ready to go in the next few weeks. So that
mhm,
allows, probably the first, roughly 40, 50% of capital going
mhm.
into the fund to be called immediately. We
Yep.
have deals ready to go, and it's a very efficient use, especially on the front end there.
Awesome. Awesome. Now, what type of fund are you guys using? I know there's Reg A, Reg D, Reg CF, and lots of other ones. What's the one that you guys use, and why did you select that type?
Yeah, for industrial fund two, it's a Reg D offering, 506C. We chose, Reg D is just frankly gives us the most flexibility to
Mhm.
raise a larger amount. We're targeting a total amount of assets in fund two that'll probably be at roughly 200 million of industrial real estate. And then 506C is nice because we can, both cater to
Advertise. Yeah.
LP relationships we have, and we can also take that fund to, more public channels, say social media, LinkedIn, whatever.
Mhm.
That gives us really just more options as a fund manager to, connect with the right LPs.
Awesome. Awesome. Now, I mean, in multifamily, a lot of people are talking about, distress in mortgages. And I am switching subjects, by the way, distressed in mortgages. And they're talking about,
Yeah.
how a lot of multifamily prices have dipped a little bit from the high. Can you tell us what's going on with the overall kind of industrial asset type, as far as is there the same type of distress? Has industrial kind of dipped from their high, or what's going on there?
Yeah, so industrial, especially in the sale leaseback realm,
Mhm,
is quite interesting. Typically the type of debt you get on these assets is going to be long-term, 7 to 10 year fixed rate debt. And the
mhm,
reason for that is because your income and your net operating income is somewhat set, based on that lease. It's going to go up a couple percent each year, but I can't wildly move that lever, right? And
yeah.
so correspondingly, I need debt that I can depend on. And
Mhm,
really the spread between, the income from my lease and my debt service, that's my
mhm,
predictable cash flow
yeah.
for LPs. So
Mhm,
as interest rates go up, my competition as a sale leaseback buyer, my competition is outside debt providers.
mhm,
So imagine you're that manufacturer. You can either sell your property to me and
yeah.
lease it back, or you can bring in outside, say, a line of
Mhm,
credit. So
mhm,
as the outside line of credit becomes more expensive, you become more and more willing to sell that asset to me at a higher cap rate, which is
yeah.
advantageous to me.
Yeah.
So that what we've seen is as interest rates have climbed, the cap rates have climbed really correspondingly in a very tandem fashion.
Okay. Interesting. Yeah. So one question based off of what you said, you say, the owners have obviously the choice of bringing in, just a regular loan from a bank, a business loan type, right? But as the interest rates get higher, they're less likely to do that. Are you seeing owners of these properties and these companies more interested in creative financing now than they were a couple of years ago? And have you tried any deals like that yet?
Yeah, and one really important piece is to know what is the motivation on, why do these business operators need capital? And what often comes to mind for investors is, oh, are they in distress, right? Is business going poorly? Do they need money to plug a hole? And the answer is actually quite different. Typically, we come in really as a component piece to a M&A transaction. So imagine you have a private equity group, they're rolling up several, we'll call it automotive widget manufacturers into a portfolio. As they buy those, often they will buy that property. If that property has real estate, that is their kind of drive to pull capital out of the real estate, get an injection of cash, and then move that cash over to the operating side of the business, really to
Mhm.
grow operations, which is how that private equity backer makes money.
Awesome. Now I'm going to change subjects again. I mean, as you're talking, I'm just racking up the questions.
Sure, sure.
So one thing you said early on, and by the way, we are going to just have to cut this conversation off because the more you say, the more I'm like, wow, that's cool. I want to learn more. But Early on, we were talking about apartments being conceptually easier to understand, right? I think everybody, I'm not going to say everybody, but I would venture to guess 95% of the US population has at one point in their life lived in an apartment building, right? So it's easy to conceptualize that. It's easy to understand that. And it's easy to think, okay, how do you add value? What am I more willing? What am I willing to pay more for? So we can conceptualize that. Now, similar with industrial, I can't conceptualize what's happening inside, a lot of these factories or whatnot. How much do you try to know or understand about what's going on the inside versus, can these guys just pay their rent? What's your dividing line on how much you're understanding their actual business before you buy something versus just looking at their balance sheet and cash flows?
Yeah, that's a great question. So the security, once you close on the property,
Mhm.
the security is how certain am I that this now tenant is going
Mhm.
to A, stay in business, and B, pay the rent. So that is, like you said, a mix of kind of their industry and their financial statement under the hood. We, realizing this, about 5, 6 years ago, we started really heavily investing in a internal credit team,
Mhm.
underwriting team. And so these guys will work, I mean, sometimes 4 to 6 months with the seller who's becoming our tenant, and they will build sometimes a 10 to 15 to 20 page report on this typically privately held company.
Mhm.
So, you can't just go to
Yeah.
Moody's and get a full spit out of
Mhm.
what the credit score is. You kind of have to do that research yourself. And it's nice, it's a barrier to entry, right? And
Yeah.
not a lot of firms have that capability to compete.
Mhm.
So we'll spend a very long time looking at not just, typically the last 3 to 5 years of audited financials. We want to see what's their debt load, what's
Mhm.
their EBITDA, what's their, revenues. Did they have a, down year in COVID? Let's
Mhm.
understand it. Have they fully recovered? And these are kind of a nuance of that. And then we look at more subjective factors, right? Hey, are they in, let's say they're in automotive. Are they in combustion automotive? Okay. Do they have the capability to pivot at some point in the future, say to more electric?
Yeah.
These are, kind of forward looking sort of
Mhm.
subjective analyses that we'll do to go, hey, do we feel that this business not only is healthy today, but is positioned to, grow with, the
Mhm.
industry they're in over the next 5 to 10, 20 years?
Yeah. Yeah. Interesting. Interesting. Now, how much of that do you guys do like pre? And I'm making an assumption that, LOIs and contracts are similar to multifamily. How much of you guys of that are you doing pre-LOI, and what are you guys doing? What part of that are you guys actually doing in the due diligence period?
Is it usually the LOI will have some high level we
Mhm.
call financial summary stuff. But I mean, as is most things in life, the real picture is often much more nuanced.
Mhm.
Just to use an example, let's say it's a private equity backed firm. I might see, oh my gosh, the revenues doubled last year, but then I have to dig in a little bit and go, oh, okay, they bought a competitor, right? And so now that revenue I'm seeing is going to be really the sum of both of these prior
Mhm.
individual firms, but maybe the debt quadrupled, right? So these
Mhm.
are things I have to kind of peel back the onion to
Mhm.
really get the core picture of what this firm looks like after I, kind of
Mhm.
peel it back and understand, the sum of the individual components that are really my guarantee that lease gets paid.
Yeah. Awesome. Awesome. And I assume you mentioned hiring somebody to come in and do all that for you. I assume that's a big part of it where, they're digging through everything, you're digging through stuff and reading their reports and all that other fun stuff. So
Absolutely,
yeah.
yeah. We've got a 4-man team who
Mhm.
100% is focused on credit. So it's a very important piece of our business model.
All right. Yeah. And I mean, when you're doing multifamily, and I'm just, going out on a limb here. With multifamily, you don't have a single tenant in a building. If you buy 100 unit property, you're going to have 100 different tenants. And so, going into each person's individual background isn't that important, but if you've got a lower number of tenants or people who are paying the rent, yeah, going into that level of detail would be more important. So
Absolutely.
just a connection I made. But anyway,
Mhm.
wow, fascinating stuff. Fascinating stuff. All right, so let's see. You also mentioned that you're still investing in multifamily. So we talked a lot about industrial. Let's hear your thoughts on multifamily right now. What you're doing in the multifamily market, and has that changed any in the last year or two?
Yeah, we have a JV partner
Mhm,
down in Southern California that we
mhm,
do, roughly two multifamily
mhm.
investment deals per year. And
Okay.
so we love our partner. We've known him
Mhm,
probably 18, 20 years now. Just started doing deals with him
mhm.
on a professional side about 2 years ago. But he is extremely focused. Him and his firm are fully vertically integrated.
Mhm.
So they have their rehab crews, they have all their property management, leasing agents.
Yeah.
All of that is fully owned within his operating company called
Mhm.
Crystal Asset Management. And then they only buy Inland Empire, which is kind of the adjacent county in SoCal next to
Yeah.
LA and Orange County.
Mhm.
And only Inland Empire, only kind of 80s vintage,
Yep.
what I call Class B or Class B plus multifamily. So it's an extremely tight focus group.
Yeah.
He's been buying and investing in this exact product type for, I mean, coming up on 25 years now. And this gentleman's been in real estate for probably almost 50.
Mhm.
Taught the real estate master's degree program at
Mhm.
Harvard University. Very talented, and so we are effectively the capital and the we
Mhm.
have oversight on the project, but he's
Mhm.
the hands-on operator
Mhm.
on these properties. And so
Nice. Nice. And when you say Inland Empire, you're talking like Riverside, San Bernardino counties.
exactly, yeah, San Bernardino, Riverside, Ontario. So really,
Okay.
it's a fascinatingly high growth area
Mhm.
because as people get priced out of LA and Orange County,
Yeah.
there's actually a net exodus out of those counties for
Mhm.
the last several years, all flowing into Inland Empire, which has been having
Yeah.
huge net increases in population year over year.
Yeah. I mean, I lived in San Diego County, two different times with the Marine Corps, but
Mhm.
we had people that were commuting into San Diego County from as far as away as Riverside, hour
Mhm.
20, hour 30-minute drive each way. And
Yep.
it was because of the affordability. They were priced out of San Diego, or they wanted a larger house, larger yard for their family. But yeah, there was a lot of good reasons that area is growing fast. But and also, I mean, I like the focus. I like the idea of focusing on one metro, which is what we're doing, focusing on a single metro. But I would imagine if he's been doing that in that area for 25 years, he knows a place like the back of his hand.
Absolutely, yeah. I mean, he could literally, I mean, rattle off the the rent
Yeah.
comps of all his properties, all the neighboring properties,
Mhm.
just from memory. Just
Yeah.
he walks every property once, twice a week, and
Yeah.
it's his rhythm, his jam, and he's done it
Yeah.
successfully for a long time.
I would imagine the conversations with the brokers are pretty interesting too. It's like, hey, Tommy's selling this one. You want it? You
Yep,
know?
yeah.
And she's
Nothing's
like, oh
listed
yeah,
before.
yeah. I've been trying to get that property for years,
Yep,
So
that's the long game.
yeah, much different conversation when you've been in the industry for, decades. So that's where I want to get in Salt Lake. I'm not there yet, but that's where I want to get. But well, cool. So what haven't we talked about that we still can?
Let's see. I mean, one other thing
Mhm.
we're doing as an investment group that's a little uncommon is we actually have an operating company arm
Mhm.
where not only do we buy the industrial real estate, but we buy the underlying operating company outright as an investment model for our LPs.
Mhm. Nice. So you're buying the operating company and the land, buildings, everything together. Now, when you do that, let's walk through a specific example. Instead of me asking questions of how that would work, can you walk through an example of, what changes with the operational company? Is it just ownership changes and everything else is maintained the same, or, you know,
Yeah,
question?
I mean, I'll tell you a quick little background story of
Yeah.
how some real estate guys got into buying manufacturing companies.
Yeah.
um, you know, with that sale leaseback model, we came in, great deal. We bought this property in Mansfield, Texas, just south of Dallas. This company,
Mhm.
aerospace parts manufacturer. They had been around a long time, just did some great work. And as we were buying the property, that company, it's called Gamma Aerospace, was
Mhm.
being acquired by a PE backer. PE
Mhm.
backer put a new CEO in place. This guy, Steve, who had a long history of investment banking and working in private equity firms. This was his first CEO role. So
Yeah.
we actually, during the course of owning the property, we ended up doing some expansions on behalf of our tenant, and we're able to capitalize some of those expansions in. Ultimately, reset a new lease, brand new 20-year lease, higher rent schedule. He was able to kind of effectively alternatively finance the cost for that expansion and grow the business. And really, it was a win-win. The company grew from 15 million a year in revenue to 65 million in just over 3 years. And everyone,
Nice.
we sold the property right as he was moving out of that company for his next endeavor. And so this gentleman, Steve, was going to start his own private equity group. And we just had such a great experience with him. We said, hey, we've got a great network of LP investors. We've got credit guys. I mean, really, we've got everything under the hood here. So he
Yeah.
set up a kind of an operating, private equity group within a real estate, overall real estate group. So to date, we've bought 4 different operating companies, all in roughly the Dallas-Fort Worth area.
Okay.
And they range, from we have an automotive transport company. We've got a concrete wall company where they pour kind of precast concrete repeating walls that you might see on the side of like freeways or utility stations.
Or in Kandahar, Afghanistan.
Yeah, exactly.
Yeah, saw a lot of those there. Yeah, yeah, yeah.
Tons of them. You know exactly
Yeah.
what I'm talking about.
Mm-hmm.
And then most recently, we bought a company just out of DFW called Hughes Tank, and they make effectively everything from 500-gallon to 25,000-gallon steel tanks, everything from hydraulic fluids to gasoline to generator assist, anything that needs a steel tank to hold it in. These guys make it skid mounted. I mean, you name it. So really core manufacturing firms. And it's been a wild ride. We really enjoy it. And, all the portfolio companies are doing well.
Yeah, sounds awesome. Now, I would assume that the PE arm of that is separate from your industrial fund. Is that correct or not?
Completely separate. Yeah. Yeah. So the industrial fund is only net leased industrial real estate. Anything outside of that's going to be a standalone investment for our model.
Okay. Awesome. Awesome. So you got a lot of irons in the fire. So you're still doing a couple of multifamily deals a year where you're partnering in Inland Empire, California. You've got your MagCP funds where you're doing a lot of industrial net lease properties, and you're also buying businesses. Sounds like things are booming for you.
Yeah, no, never a dull moment. That's for sure. It's
Yeah. Awesome. Awesome. Well, hey, great catching up again. Thanks for sharing everything. So I guess, one question that I should ask before I close up actually is, what's next? Are you going to start buying states?
yeah. Really our core focus has always been industrial. Probably
Yeah.
about 75-80% of what we invest in is still industrial real estate. And I mean, right now there's more opportunity. I mean, if I had $500 million, I could put it all to work in the next 3 months. There's so much opportunity out there right now, especially in this glimpse of time. So I mean, we're really just doubling down on what we know works, fundamentals. That's Midwest, low basis industrial real estate. Long-term holds, really consistent cash flow, tax depreciation. A lot of that same stuff you're seeing in multifamily. And I mean, that's what we've hung our hat on for a long time. And, what's next is really just doubling down on what works there.
Love it. Love it. Yeah. You got the model set up and just rinse and repeat, and I love that idea. So awesome. Well, hey, Neil, thanks for coming on the show again. Appreciate your time today. Like I said, great catching up. And last question, how can listeners learn more about you or what you do?
Yeah, no. Well, you can listen to episode 111. No,
True. Yeah.
no, you can reach out to us. So MAG Capital Partners. Just look us up online. That's magcp.com. We've got a whole team of folks happy to chat with you on kind of what we're doing. And if you want to dive a little more on the investment side, there's an easy way to connect with someone on our investor team there.
Awesome. Awesome. And we'll put a link to the website and everything else in the show notes for anybody listening. So once again, thanks for your time and appreciate you.
Thanks, Brian.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.